All right. Welcome back to another episode of the Real Estate Investing Club. It is a beautiful day. I am actually down here in sunny Santa Rosa, California. We're down here with my family for a month. So there's going to be, you might hear a little bit difference in my voice because I'm recording from my laptop today. But that's life. That's like real estate. When things are different, then you just find a solution and keep going forward. Today's a good day because we have Adam Zock with us from Home Equity Partners. Adam focuses on single family. He does rent to own. And I'm super excited about this because he has a very unique strategy, which I will let him go into. Adam, thank you very much for hopping on the show.
Hey, thanks for having me. It's fun to hear the travels and all the life freedoms and challenges that real estate has to offer. I love it.
Absolutely. I told you before we got on here, we like to start with stories. So why don't you take us back to the beginning of your story? How'd you get started in real estate?
Sure. The 30-second bio is grew up in North Dakota, population about 10,000 people, and family of 6, went to civil engineering school, graduated, thought that that was just going to be the ticket. I had a pretty good high-paying income, and then my foot starts to tap underneath the table, being like, do I really want to do this? And I remember thinking that if I worked extremely hard, I could maybe make an extra 5 grand. And that return on investment just wasn't quite there. And I never knew exactly what it was. I just knew that I wasn't in alignment with what I thought I wanted to do. There was nothing wrong with it, and so it was more I wanted more. And then the more I wanted more and the less I felt in control, I just had like this deep pain. Then it was like, I got to do something. So It's like, it started with fantasy sports, start doing some trading, try to do some betting, see if I can, get my outlet that way. Then it was like day trading stocks because then it got a little bit more serious. And then I sucked at those. It wasn't like a real money maker. And I was like, you know what? It turns out everyone makes wealth and retires early through real estate. Why don't we give that a shot? And turns out you start knocking down a couple dominoes, bought a property, had my 3 old college roommates living it with me. So they were paying $300 a month to me in a 4-bedroom. So it was $900. And I think the mortgage was right around $1,000. So I was pretty much living rent free. Did that for 4 years and realized that the home appreciated from $147,000 to $169,000. My mortgage went from $112,000 to $108,000. And I was like, oh, cool. Like I just built like 20 grand in equity for doing almost nothing, to which it would have taken probably 1,000 hours of engineering work. And I was like, oh, let's just do this. So then you start listening to Bigger Pockets. And then I wanted to quit my job like immediately. And luckily I had people smarter than me around me to advise against that. But it wasn't, so that was the first property that I got. But then it was waiting probably 3 years till I got my second property.
Oh, wow.
So it was like the first one, playing it out, figuring it out, like what is this? And then but just getting that first one was so huge because then we rented it out, bought the next one, moved to another house.
You proved the model. You saw that it worked. You're like, okay, I get this. We can reproduce this.
And then once I found my business partner, who's still my business partner today, you add in the extra time, the extra capital, and somebody to bounce off ideas, because Adam feels like he's pretty smart, but I make a ton of dumb decisions. But if you get 2 people, just like a husband and wife, between the 2 of you, it's pretty hard to make a bad decision. And so that's been tremendously successful in my investing career, which has led to everything that we've done today, which is, roughly the 100 single family homes. And we're, buying about, 30 to 40 every year.
That is awesome, man. I love that. And yeah, it is so important. And so I feel like you should consider yourself lucky when you find a good partner. Having a good partner in real estate can really move things along and just making it the entire experience that much more enjoyable. It is difficult to find good partners, but once you got one, it sounds like you got one, then you just hold on to them and you guys, enjoy the ride. In your story, I thought it was interesting that you said, you bought that first house and then you waited 3 years, and it sounds like you were thinking about quitting, but people around you are saying that's not a good idea. I remember back when I first got started, it was really hard. I was in the same boat. I was working corporate. I had the salary. I was doing fine, but I just wanted something else. And it's just so hard to know when you're in that situation, when is the right time to pull the cord, to make that leap. And you're never going to find arrive at a junction where you're like, okay, this is it. This is perfect. It's never going to feel perfect. And so you do have to kind of come to the realization, like, I gotta shit or get off the pot. Excuse the language, but you got to just make that decision. So at what point did you realize, like, now I'm going to quit? I'm not going to be working corporate anymore. And at what point did you make that transition into full-time real estate?
Yeah, so for me, it was easy. It was 60% of my take-home pay
Mm,
through my
mm,
side hustle. If
mm,
I can make 60% working part-time, that's a game changer. And I think people have two choices. I could have left engineering and done something similar, like a real estate agent or a mortgage loan officer or a property manager, which would have been a little bit more in alignment. But it
mm.
turns out I had an incredibly good salary, and the extra capital and bankability was worth more
Yeah.
than making a parallel or maybe a diagonally downshift into a similar real estate vehicle. So it actually made sense for me to not switch. And if I would have jumped, of course, there's always the story of like, hey, does it work or does it not work? But like, if you go from making, $7,000 a month to literally zero or like $500 a month, you get into such scarcity and desperation mode that maybe
Hmm.
that's
Yeah.
exactly what you need. But if you're starting a family and doing other things, like, yeah, maybe if I was 21 and I had no responsibilities, like it would have been great. I would have just, brute forced it and Grant Cardone or Alex Hormozy and just work 80 hours a week and just like make it happen. Sure. But if you're starting a family, it's like, okay, there's that baseline security. And then I was advised, like, hey, Adam, if you want to do this and you did it in 10 years versus 2 years and you're 39, instead of, 29, how would that work? And I was like, that's still freaking awesome. So, hey, can you make at least just a 10-year plan? Buy two properties a year for 10 years, then buy two and sell two, and I'll retire early. And I was like, okay, that seems very doable. It's not as fast as I want it because I want it tomorrow. Who doesn't? But if you just say two properties a year for 10 years, that's it.
Yep. And that is, I mean, that's extremely doable, especially if you have a W-2. You said 60% of your salary you wanted to have in earnings. Now, is that all cash flow, or does that include active income like wholesale, stuff like that?
Yeah, it was a combination of the two, but it wasn't like gross revenue. This
Mm,
was I'm going to move
yeah,
from the business to my personal bank account 6 grand a month.
yeah,
And
makes
if I
sense.
could do that and you could pay the basics, like okay, we're good to go.
Yeah, yep, that makes sense. Notice so in your submission to the podcast, you wrote down that the title should be "How to Wholesale MLS Properties with Rent to Own." That is a strategy I have never heard of, and so why don't you take me through that? How do you guys actually do this?
Yeah, this is like I'm gonna call it Home Equity Partner is like version 4.0 of our business. Of it started off where we, just did rentals. Then it was we told college kids to go pick a house listed for sale. We'll buy it and rent it out to them at the 1% rule,
Oh,
just to
interesting.
like
Okay.
cash flow. So we started doing that, but then they'd move out. And then it was like, okay, well, now we got to rent it at, market rent, which wasn't quite as cash flowing, but it was like, okay, how can I get somebody to buy it? And then I landed on like Joe McCall and Chris Crone and lease options and what rent to own are. I was like, oh, cool. Can I do the same thing? But then they buy the house back for me. And I was like, this is kind of what banks do. So we're trying to play between bank and a landlord, where the bank actually finds the person first, gives them a pre-approval letter, borrows money from us and then lends it back out at just a yield spread. So that's
Mhm.
really all we're doing was, so then version 3.0 was we were buying them all ourselves, where we would just go find someone who can't get a bank loan. Whatever we got for a bank loan, let's say it was 4%, we would charge 7%. So when the interest rates were 3%, we were charging 6. And if they're 7 right now, we're charging 10. And all it is just, hey, is someone who can't get a bank loan willing to pay 3% above whatever prime is? And the answer is yes. There's some people that hate renting. Are they willing to pay that? And the hard part is maybe finding those individuals. So then it was just find the person, not the property. And now I'm not finding motivated sellers. I'm finding motivated buyers. So that was kind of version 3.0. And now all we're doing is we're saying, hey, if I can find those individuals who can't get a bank loan, they're like, hey, I want this house in St. Louis, Missouri. It's 240,000 and I'm willing to pay 2,400 a month in rent. An investor in today's world is like, I can't find a cash flowing property to save my life, giving a 7% interest rate, depending on what markets that you're in. And so that's where we started putting homes under contract, contingent upon us assigning it to an outside investor and the investors actually buying the home kind of turnkey with this rent to own candidate who picked out the house in the first place. And so a lot of this is an investor could go to their local loan officer or real estate agent and just say, hey, is there anybody that is denied or can't get a pre-qualified letter? Send them to me. And then you go ahead, figure out what they want, screen them, and say, okay, based on your income, if you make 7,000 a month, go pick out any house under 250,000.
Mm.
So you know that they make at least 3 times the monthly payment. You say, okay, your monthly payment's gonna be 2,500 a month. You go with that, and then you say, okay, go pick out the home. Once they find it, you get it under contract. You can either close it yourself, or you say, hey, local investor group, I have this property that's going to close in 45 days. It should cash flow $300 a month, and it'll start day one. And then the kicker onto that is we found rent guarantee insurance, which is like the equivalent of private mortgage insurance. So they're
Mm.
guaranteed rent for 3 to 6 months, even if this tenant defaults. And so you layer that on, and we make it pretty attractive to the rent to own candidate and to the investor. And so now we're buying and selling MLS listed properties and wholesaling them to investors by just connecting people that can't get a bank loan to people who want cash flow on single family residence.
Interesting. Very interesting. Um, so if this, I'm just thinking a lot of the times when you buy properties, single family, especially, you get uh, um, a conventional loan, 10% down, 20% down, whatever it is. If you're selling it as a lease to own, or rent to own, does the bank generally get in the way? Because usually they don't want, they want the person, who purchased the property. They definitely will not allow anybody to be in second position. But since you're renting it, I guess it's a different situation. What do the banks usually say about this?
Sure. So there's kind of 3 ways to sell a property on creative financing in my mind. It's a true seller finance where you're, coming off a title, which we don't recommend. There's a land contract or called contract for deed where it's equitable interest, but the title doesn't change. Or there's lease with an option to buy, which
Mm.
from all practical purposes, they're not on the county, they're not on title. All it is a rental agreement. And so from our perspective, you can tell, and you can tell your loan officer everything that you're doing. What we found is it's much simpler if you just say, hey, I'm renting out this property. And if you
Mm.
tell them that, that's, is there an option agreement? Sure. But the more information that you share to them, they honestly don't care as long as it meets their debt service coverage ratio. You have to show proof of funds that you're getting it. But how we structure it is the tenant buyer is actually wiring money to the closing title company in addition to you. And as long as you have the source of funds, say you have 50K sitting in your bank account and the HUD says you need 47,000, whether you bring 30 and the tenant buyer brings 17, the loan, company doesn't really care. They just want to see, hey, you have the funds, here's the way going. And then part two to that is we've transitioned from conventional loans in our own name to business loans just because they're way easier. And when we
Mm.
say business loans, it's taking title in an LLC.
Oh, interesting. You find that's easier than personally guaranteed loans.
Sure. So, and if I was breaking that down a little bit, if I did the first 5 properties in my old name, right,
Mm.
just the normal Fannie Mae, Freddie Mac, secondary market, do all that, you get the best terms, the best rates, no prepayment penalties, anything like that. But they ask for debt to income ratio. They want all your income. You have to like qualify for all this stuff, which is all the people, ironically, who are trying to help. Because if you're self-employed, like me right now, like I can't get a conventional loan, which is really weird.
Yeah,
Like
yeah, I
on
know.
paper, I show a loss. And so it's like
Yeah.
I'm ironically, built this company to specifically help like those individuals like myself now where, I don't look, I don't meet the exact boxes of the bank. On the what they call on the business banking side, or what we call commercial loans on single family residence, it's more of a, call it a hard money loan. It almost looks like that, but without the fees and the points. It's like your local credit unions who are doing portfolio loans where they're just lending out their own capital. They have to meet FDIC rules. They're not selling it on the secondary market. And so it's still maybe like a 1% origination, maybe a 20 or 25-year AM versus a 30-year AM, and maybe a 0.5% interest rate higher. But what's cool is I can do, and I have 5 million of debt from the business loan, $0 show up on my personal credit. So if you
Hmm.
pulled my credit right now, I have, no debt associated with any of that. It's all on the business side, which means I can do as many as I want. But of course, you can do, 5, 10, whatever the limit is on the conventional side. They're super easy. They're the most, straightforward. And I've having done both of those so many times, we started off in the conventional side, which I would recommend starting off with, and then we just transitioned into the business side.
Interesting. So I love using examples. So let's just say I found a property in Charleston, South Carolina. 3 bed, 2 bath, $200,000. I go go to the property, I look at it, looks good, something I want to buy, rental rates seem good in the market. So I go and get a loan on this. I put, let's say, $20,000 down, 10%. And then I go and you list this exact same property on the MLS as rent to own, or I guess it's already on the MLS. You can't list it on rent to own. So where do you find the rent to own buyer?
Oh, good question. So you could do inventory first or
Mm,
people first. We
mm,
started off in your exact situation. We would buy a home, and in our offer, we would say contingent upon being able to list this as a rental. So then in the next 45 days, I'm putting it on Facebook Marketplace. They take it off of Zillow, and I'm advertising it as a rent to own so that hopefully in the next 45 days, I actually have a tenant buyer, which we call the rental, the candidate who wants to move in on a lease with an option to buy, that I have 45 days where I'm marketing it, hoping that I find someone who can move in the same day I close. So that's kind of strategy one, which is get it under contract, find your property first, find the tenant second, which is honestly a lot easier because some people like it. It's the more traditional way. However, what I might suggest is you go to your local credit union and you say, hey, is there anybody that you denied a loan this last week? To
mm,
which their answer is almost always yes. It's like 5, 10, however many people. It's usually credit or debt to income ratio because they're
mm.
self-employed. So it's like, do you have below a 580 credit score, or are you self-employed for the last couple of years, or there's some sort of weird debt to income ratio going on? So in that case, you would find that person. In our space, we say it's a minimum $200,000 house. You have to make at least $7,500 a month, and you're putting 5 to 20% down as the tenant buyer. And in a perfect world, right, they're putting 10% down. And in that case, you're putting 10% down. So you're almost coming in with no cash. Maybe you're closing at a 7.5% rate. Your mortgage is all in at 1,600. You do a lease to own at $2,000 or $2,100 a month, and then they have the exclusive option to buy that home back from you anytime in the next 3 years for $225,000. So you kind of build in your profit. If it goes above that, great, they win. If it goes below, they don't. They can walk away, but who's going to walk away from 20 grand if they're putting down 20 grand? But again, that's their option. And so then you're essentially playing a yield spread where you're borrowing from the bank, charging them, and for taking on that extra risk because they don't fit the bank requirements, because of a debt to income, because of a credit score, whatever it is, you as the investor are deciding, hey, is this worth that to me? And so then to take it another level further, you could just go buy this and Gabe could close on it and he'd have the tenant buyer and you'd be getting $500 a month in cash flow. Or what we say is we end up assigning it, taking a 5 or 10 grand assignment fee on that, $20,000 to $25,000 spread. Or when the tenant buyer is bringing 20% down or 10% down, 20 grand in your case, you would maybe take half of that. So the investor comes in with their 20 grand minus the 10 that they're paying you. So they're in it for 10 grand. They've gotten 20 grand from the tenant buyer, which, maybe half of it went to you, half of it goes to them. And then they have a cash flowing property at $500 a month. Does that make sense?
Yeah, yeah, it's a really unique strategy. I love creative financing. I love this kind of stuff, especially when it's really it addresses a need in the market. People who don't fit the bill that banks are looking for. You and I both self-employed. We make plenty of money, and yet banks just don't want to.
And
My significant other, she has an actual job, and so we're buying houses with the W-2 with her W-2, but I make more money, but I still don't, banks don't want it because it's single family.
And what's interesting and where I really love this is there's 125,000 people every month searching rent to own into Google.
Yeah.
And
Oh,
so I
interesting.
so I'm it's pretty cool. So we're doing a lot of Google ads. We played with Facebook ads or different things. So like how I normally did is I would, scrape the list, get it from Lead Sherpa, whatever it was, mailers, text campaigns, all that, and I'd find motivated sellers and you go that route, or I'd have to search MLS, buy a property, hoping I'm getting the rentals. Right now, all I'm doing is tapping into the people searching into Google rent to own homes, and then they just go to our landing page. We're screening them, making sure that they have the cash and make sure they have the income. I could care less about credit score, but if they're putting 10 or 20% down, there's almost no one, Gabe, that I wouldn't buy a property for that's putting 10 or 20% down on a house. It's almost impossible to lose money on that type of a deal.
Yeah. Yeah, that was actually one of the things that popped in my mind is, these people aren't technically owning the house; they're still renting it from you. And so, in my mind, I've done the rental game with single family in my past, and I know people destroy houses. And so, my initial concern is, what if these people default and you get a house back that's just completely destroyed? I guess since they're putting the down payment down, that is your assurance, can they do $20,000 of damage to the house? Yes, they can, but is it likely? Probably not.
No, and we've had that.
Yeah.
And the tough part is and that's why we've gotten away from land contracts, is because in North Dakota it takes 5 to 6 months to foreclose on someone versus an eviction,
Mm-hmm.
which is 30 days. And so
Yeah.
time usually kills a
Yeah.
lot. So if you're holding it and it's losing money for 7 months, that really hurts you. But if you are able to get it back in 45 days, that helps. You add in the rent guarantee insurance so that as you're fixing it up and selling it, you're still getting the $2,100 a month in rent through your rent guarantee insurance until the home sells.
Mm.
Now it's just a matter of, do you want to re-rent it or are you going to list it and sell it? And we found that, yeah, if someone really destroys it, it's probably no different than a normal rental or a
Mm.
normal like FHA loan where somebody's putting 3.5% down. Could they trash it? Yep. Is there going to be that? Yep. And all you're doing is kind of hedging your bets. And of course, the biggest lever that you can play is just how much down payment or skin in the game. And so we've screened over 500 tenant buyers, and we've came up with kind of this rating system based on past rental history, based on their credit score, collections, judgments, evictions, bankruptcies, income history, that we kind of created our own private rent to own screening process, because now we have data to back up, okay, who buys, who defaults. We want everyone to buy it and we want them to make money. And it's really cool when we get the 5-star reviews, because it's ironic that we charge more than anything else, which, is a little bit, if Adam's being full disclosure, it's like, well, I wish I could charge less. However, given the situation, if I'm borrowing at 7%, I honestly can't rent it out at 7% rate and make any money. So it's like
Yeah.
that we're very transparent on the website. Like, hey, if you can get a bank loan, great. If you want to rent, great. If you only want to move once, if you can't get a bank loan and you want to pick a house listed for sale and rent it with the option to buy it back, we are your one person. And for that, we charge a premium. And now I feel very comfortable with it because we're doing something else. The last 20 people we put into homes, I am very confident that Adam and Home Equity Partner and our team are the only people on planet Earth that could have made those people homeowners in that specific situation, which feels really awesome.
That's pretty cool. So two other questions. One, rent guarantee insurance. Never heard of it. Where do you actually get that?
Oh, it was wild. So like this is just Adam's former engineering brain going. I was like, okay, what's the biggest risk? They stop paying rent. And I was like, okay, how do you hedge against that? And I was like, ooh, can I get private mortgage insurance for renters? I was like, what do the banks do? Right? They're like, oh, they just make the tenants or the loan applicants pay for PMI so that if we default, unless you put more than 20% down, they just do the insurance. And it's like the banks are playing heads, they win, tails, they break even. So I was like,
Mm.
cool, how do we do the same thing? So I started searching. So there's 3 companies. One's called the Guarantors, 2 is called Leap Easy, and number 3 is Single Key. All in the United States. They have their own underwriting criteria, but one of those 3 will offer rent guarantee insurance, some sort of coverage. And all it is we make the tenant buyers pay for it, roughly $83 a month per $2,000 a month in rent coverage. So
Mm.
it's almost just like homeowners insurance, right? Like
Yeah,
you're
yeah, yeah.
doing it hoping that they don't. We've done this, and now we make the tenants pay for this. So we bake that $83, or we make them prepay for a full year. So maybe they put down $800 and they've prepaid for rent insurance for 1 year or 2 years. And so those are the 3 companies that do it. And it's essentially you're paying that. If they default, you put in the claim, then they pay you out every month until you either re-rent it or you sell the home. And then some of them will cover eviction costs, some of them cover repair costs. And I was like, oh, this is just if you're getting people that are only doing 650 or 700 credit scores and they got the W2 job and it's like a 2% default rate, sure, like that's how the insurance companies, and they have to make money. For our specific case on the rent to own, if the number one risk is tenant buyer default, I'm using insurance to our advantage, and we're placing that on every single one that we do. So they do it, and the pitch is both to landlords in that if they default, you get your money, but it's also to the tenants who, let's say they apply to an apartment or a normal house and they don't have the credit score. Landlords or property managers like, nope, you can't do it. Well, what the guarantors does is like, hey, here's a bond saying if the tenant defaults, I'm guaranteeing I'm paying the rent. Well, now if I'm a property manager, I'm like, sure, I'll take that, right? Like if they don't meet my 580 credit score, but someone's guaranteeing that they're going to pay rent, almost like a cosigner, and it's literally
Mm.
an insurance bond guarantee. like it's kind of the equivalent. So now these individuals with not credit score, it's attractive to them because now they can get into the apartment or the house that they want because this insurance company is backing them. It's
Interesting.
wild.
Yeah. Okay. One other question I have is locations. It sounds like this could work feasibly regardless of the metro you're investing in. I'm from Seattle, Val's from Santa Rosa. So California, Washington, two coastal cities. The median house price is 400, 500, 600,000. And so it's really high. It sounds like this is best used in situations where it's a lower price point. Have you
Yep.
done it in coastal cities or high price point cities, or do you usually focus around the $100,000 to $200,000 purchase price?
Usually 200 to 450,000 is our sweet spot in the Midwest to Southeast.
Hmm.
Um, and for that is we're designed this, not saying that another investor couldn't do something else. If you're in California and you want to do a $400,000 house and you're willing to take the negative cash flow, but then add on maybe 8% appreciation per year so that if they buy back the home, that's your play and you're getting your long-term wealth versus your immediate cash flow. What we're in the game of is cash flow. And so
Yeah.
for us, if we're going to do the same model, if someone's picking out a $500,000 home, they have to pay $5,000 a month. And in
Yeah.
California, someone's like, no, why would I do that if I can rent for $3,000 a month? It's like, okay, fair enough. However, if you're in St. Louis or Little Rock or North Dakota or Minnesota, there's people doing that all day, every day that are willing to pay that amount because it's essentially the equivalent of a 10% interest rate where they lock in a purchase price for X amount of years along with a locked in rental payment and they don't have to move multiple times.
Interesting. Cool, man. I love this strategy. It's cool that you guys got it figured out. I had one other question. We already talked about the locations. Oh, right. So I've never done a rent to own. Where I focus mostly on commercial now, and so I don't really know how it works when it comes to repairs and maintenance. Since it is a rental still, are you still performing all the repairs and maintenance yourself, or is that now, how does that work?
So in a true land contract, 100% responsibilities are on the tenant buyers. In a lease with an option to buy, every state and city has their own century codes and statutes on what you can or can't do, and it's a gray area. So we have attorneys review it. In general, if you wanted to be aggressive as an investor, you could say anything above, $500 is a responsibility of the tenant buyers, or anything, below 10 grand is the responsibilities of the tenants. And we've had that in our option agreement. So in general, you can go the full spectrum. Tenants, you pick this house, we make them get an inspection. They know exactly what they're moving in. So we try to play it like a bank. However, if you're in certain cities, it's like, okay, well, you have to take care of the roof or the HVAC or the plumbing, but it's really, location specific. And since, we're in 20 some different states, it's a little bit unique, but in general, it's like you got to get the certificate of occupancy to, pass it as a normal rental inspection. But in general, it is significantly less, and they are taking care of the home, not you as the landlord for repairs and maintenance and different things.
Cool. Right on, man. Well, I appreciate you sharing this strategy with myself and everybody listening. It sounds like something that a lot of investors out there might want to take advantage of. So with that said, let's hop into the quick question round. Are you ready?
Sounds good, game.
All right. Starts with books or any form of education. I need two recommendations, one for general life wisdom and then one for real estate specific.
Sure. I'm I'm going to caveat this that depending on where you are in your real estate journey, you get more and more niched.
Mm,
So Adam could give you a recommendation having done 100 real estate transactions, and I could say, "Hey, the road less stupid for you, Gabe, as a business owner is something I would highly recommend," which is like a lot of thinking time, high strategy. However, if I'm going all the way back, I'm going to say The Millionaire Fast Lane by MJ DeMarco from a real
okay.
estate investing and like how you're structuring different things. And then as far as general life advice, I recently stumbled upon 101 essays.
Mm,
And I'm actually blanking on the offer because it was an Audible free book and a credit. Amazing wisdom and life advice from there. So those are the ones I'm going to go through versus the traditional ones that I normally recommend.
cool. Yeah, I love essays just because they're kind of smaller. You can consume them in one sitting, and usually they get to the point pretty quick. I used to really like reading Ralph Waldo Emerson. He has a bunch of
Mm,
essays, and yeah, that sounds like a good piece of reading material there. All right, next question is about your younger self. So let's go back to the Adam who was still working as an engineer so many years back. Go back to him, look him in the eye, give him one piece of advice moving forward.
Sure. I would say appreciate the past, which means life happens for you, not to you. And the more and more times I would say that to myself or give myself a little bit more grace as I was going through the thick of it, as I was starting a family, having 3 young kids, starting a business, which is like a whole nother kid or family, however you want to look at it. There was a lot of times where I would see and I would think life was happening to me. Why did this tenant stop paying? How come I have to evict? Why did this go right? And if I just realized that everything was happening for me, not to me, and if I just used that mantra, it maybe wouldn't change anything other than just my stress level and personal
Yeah,
satisfaction with life, realizing that this is all for the greater good.
yeah, yeah. The more you get into business and the challenges start coming up, you realize that it's that is life, and those things are necessary for growth, and it's you start to appreciate them the more you get into it. So love that piece of advice. I'm going to move us on to the next question. This is about your business. The first 3 positions we hire form the foundation of our business moving forward. So what were they for you, and would you hire them in a different order if you did it again today?
The excuse me, just the first 3 hires.
Yeah, or
So for,
positions you hired for. Yeah.
sure. So for me, it was a little bit unorthodox. So hopefully this will be a change of pace. But number one for me, it was a running mate. It was an actual equity business partner, which I know Dave Ramsey says the only ship that doesn't sail is a partnership. And I would say, well, I equate that to marriage too, right? Like 50% in a divorce. But if you're trying to give the other person the better end of the deal, you truly honor them and you have integrity, man, you can go so much further with 2 people. So for
Yeah.
me, it was that our number 2 was a salesperson, and then number 3 was an operations guy, which was like take everything that we have, systematize it, and automate it. So it was business partner, salesperson, and then an operations dude.
Cool. Love it. All right, next question is this is a good one for you since you guys are in so many states. The United States is a big place. There is a lot of opportunity out there. So give me the single metro you're most excited about investing in today.
Sure. So for me, I'm going to say Fargo, North Dakota, because that's where I'm at.
There
And
you go,
the
backyard.
re the reason that I like that is in North Dakota, it goes up by 4% to 5% per year, every year for like 40 years. Like in
Damn.
2008, 2009, up 4%. We had the oil. In 2021, up maybe 5%. Because like it just doesn't change. So for me, slow, steady, consistent 4 to 5% is just the tortoise winning the race.
Yep, I like that.
And
All
it
right.
happens to be where I know. So that's always the advice that I give other investors is just you got to pick something, and it usually starts with where you know. If you're trying to find your next property, you probably already know the market, or you have some unique advantage where you understand the industry. And so just to get your next one going, or just to take the leap of faith, it just removes some barriers just because you might know some contractors, you might know some areas, some schools, or have a unique unfair advantage over someone who's long distance investing.
Yep, absolutely. All right, next question is about finding the deal. It all starts with getting in contact with the seller and hammering out that purchase agreement. So, what is your favorite way to generate leads and find good deals?
Sure. So I'm going to say one, a little bit contrary. So I stopped finding sellers and started finding buyers. And so right
Mm,
now it's all real estate agent, loan officers, and Google Ads where I'm finding motivated buyers. However, when it was the sellers, I would make any offer contingent upon a signed lease. And it's
mm,
kind of like the weasel out clause, where it's basically like, hey, for any reason, I can back out of this deal and you can't come after me. And so I would put a property under contract, look for anything listed, make it contingent upon a signed offer, submit 10 offers a week. And if somebody accepted it, just start showing it to tenants.
and
And if I got a
were you
tenant that,
just offering asking price, or were you offering, you know,
if it was a really nice home and it was on the market for 13 days, yes. If it's been on there for 60 days, oh, I'd lowball it, add in all the contingencies, and often those ones you get a little bit more, acceptance. And then once you get through inspection period, ask them for, all the things that you want them to, because if they say no, it's usually more pain for them than it is for you, especially when you're under contract.
yeah, that makes sense. All right, next question is about lessons learned. We've already kind of gone over this, but let's go to a specific lesson. Not every deal that we get into goes the way we expected. In fact, many of the deals go a little sideways. But in those opportunities or in those deals is where you have the opportunity to learn. And so, what is a deal that went a little bit sideways for you, and what was the biggest lesson you pulled from it?
I've realized how powerful financing can be
Mm,
and the potential hiccups of prepayment penalties. So, having done my fair share of DSCR loans where they have like a 5, 4, 3, 2, 1 prepayment penalty, and it's like, oh, interest rates dropped from 6% to 3%, or we need to liquidate the property, and all of a sudden there's a, whatever percent prepayment penalty on something where it can really crush a lot of your profits, or you're not able to refinance out of a home. I'll say that was probably a more recent one. That just has a little bit more sting to it, where you're looking at the financing and looking at different things. I would say look at the long-term play of it. If you're doing the conventional loan, it's super easy because they don't, they're all required to not have a prepayment penalty. But just thinking about loan origination fees and different things, because how you structure a deal and how you can get the interest rates, terms, origination, buying down the points or adding in points, try to figure out how you can structure it. You forget how powerful the leverage is on the financing side, to make a deal work.
cool. All right. Okay, that leads us to the very last question. This is for the listeners. You've given us a lot to think about, and a really good strategy for new or veteran investors to give a shot at. I'm sure people want to reach out, get in contact with you, learn a little bit more about what you guys do. So, what is the best way for them to reach out?
Sure. If you want a copy of a free lease with an option to buy contract vetted by real estate attorneys, you can go to homeequitypartner.com/investor. And from there, you can go ahead and download a free PDF. Just drop in your email and we'll send it to you. And then we have a bunch of other information on how we do this, how we're wholesaling them, some pricing strategies, just because I really believe in the mission of helping people become homeowners and transforming them from renters into homeowners. And it happens to work out pretty good from an investment standpoint too.
Perfect. That is home equity partner, singular, not plural, .com/investors, correct? It's
You
plural
got it.
investors. All right.
Correct.
I will put that link in the show notes. So if y'all want to reach out, just click a little more in the description. It'll pull down that full description. In there, you can find Adam's link. All right, man, that wraps it up. I really appreciate you hopping on here and sharing everything that you shared.
You're welcome, Gabe. It was a pleasure having us. And I like the short, sweet, and impactful conversation that we're able to have in 20 minutes here.
There you go. Get in, get it done. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. And if you want to support the show, all we ask, give us a like, subscribe, share, all that jazz. Other than that, I hope you have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.